On Thursday the 13th of August, 2026, crypto exchange Bullish dropped a confusing set of second quarter numbers. The net loss was a hefty $280 million, yet adjusted earnings landed exactly in line with analyst expectations. That is a huge tension. How can a company lose that much money and still be described as in line? The answer lies in what the market strips out. Adjusted earnings remove one-off, non-cash, and accounting items that can swing wildly from quarter to quarter. The headline loss may sound alarming, but the underlying operating picture is much steadier. That gap between the scary number and the stable adjusted result is the story today. The quiet engine behind this result is subscription revenue. While digital asset trading slowed, those subscription fees kept growing and offset the weakness. This is a deliberate strategic shift. Trading income is tied to volatility and volume, both of which fell this quarter. Subscription revenue, by contrast, is recurring and less dependent on whether traders are active every day. Bullish has clearly been building out services that generate recurring fees. Across the sector, Galaxy Digital showed a similar pattern. Its digital asset adjusted gross profit rose 34% quarter-on-quarter to $66 million, even though crypto prices and trading activity were lower. The lesson is clear. Firms that diversified away from pure trading are now proving more resilient. For investors, the $280 million net loss is still a warning sign. Even if it reflects non-cash markdowns or one-off charges, it tells you the core trading business is facing a genuine slowdown. The digital asset market has been quieter, with lower prices and thinner activity. That means future profits will depend increasingly on subscription revenue maintaining its momentum. The adjusted result suggests management has enough recurring income to cushion the blow, but it has not eliminated the risk. If trading volumes stay weak, subscription growth will have to keep over-delivering every quarter, which becomes harder as the base gets larger. In short, the company is safe for now, but the safety net is thinner than the inline label might suggest. Looking ahead, the next test is immediate. August is traditionally a quieter month for crypto trading, so there is little reason to expect a sudden rebound in volumes before the end of the third quarter. If anything, the summer lull could keep pressure on transaction fees. That puts the focus firmly on subscription revenue again. The key question for the next earnings update is whether it can keep growing quickly enough to offset another weak quarter of trading, not just in Q2 but into Q3. If it does, Bullish will look increasingly like a diversified financial platform rather than a pure exchange. If it stalls, investors may start treating the $280 million loss less as accounting noise and more as a sign of deeper problems. So the real takeaway today is not the huge net loss. It is the shift in how Bullish makes money. Subscription revenue has become the shock absorber for a slowing crypto trading market, and that is exactly why adjusted earnings managed to stay in line. The challenge now is durability. A diversified revenue base is attractive, but only if it can perform in a sustained downturn. Watch the subscription trend closely, because it will determine whether Bullish can survive the current crypto winter without a much more painful reset.